Hello traders, welcome back to my channel. How are you all doing? In this video, I'm going to talk about how to create a trading plan. And it's going to be a step-by-step guide for traders. Very quick video. Tell you one, the importance of a trading plan, two, what a trading plan contains and how you can create your own trading plan. So why do you need a trading plan? It's extremely important for every trader to have a trading plan. It helps reduce emotional trading because there is a set plan that you are following and you just go strictly by it. Removes emotions completely from trading. Also helps to provide structure and discipline as well. Again, if you have a structure that you're following, all you need to do is to stick to that, not deviate from that plan, and that would normally guide you to a profitable path. And it also helps you to measure your performance as well. So included in the trading plan is a trading journal where you take notes of all your trades, the reasons why you're entering the positions, and usually at the end of a week you can always go through that journal, see where you've made mistakes or what your mindset was while you were taking a particular trade. So we're going to start with the first step, is to define your goals. So before you do anything, really, you need to have an objective, an aim of what you want to achieve at the end of the day. And the same applies with trading as well. So for example, you can set a goal for yourself, again, for the week or for the month, and it has to be SMART goals, which means it has to be specific, measurable, achievable, relevant, and time bound. So as an example, you can set for yourself to earn about 5% per month on a consistent basis. And it is very specific because you have a set goal, very specific number that you aim to achieve at the end of the month. You have a time period, again, which is a month. And this 5% on the trading account is achievable as well. It's not unrealistic at all. So before you start trading, set a goal for yourself on what you want to achieve in the forex market that week or that day or that month or even in the year. The second step is to choose the trading style. So there are different trading styles, 4 trading styles to be exact. So scalping, day trading, swing trading, and position trading. Personally, I tend to swing trade the market, and mainly because I don't work full time as a trader. I also work as a medical doctor as well. So I don't have the time to be in front of my screen every single day. And so I have to be able to set a trade, enter a position, and hold the market until it gets to my take profit without me having to monitor the market every single time. So you just need to choose what sort of trading style suits your lifestyle essentially. So if you're the type that just want to go get into the market, get out very quickly, take whatever you can take, scalping might be the best one for you. If you have the time to be able to sit down, analyze the market, be in front of a computer most of the time, again, day trading might be suitable for you as well. If you don't have the time, you're working a full-time job and you're using trading as like a side hustle, then swing trading or position trading might be the best style for you. So you need to stick to one, choose what you want to do, and note that in your trading plan as well, and always stick to that. The third step, again, is to set your risk management rules. So generally, in terms of risk, we tend to set between 1 to 2% per trade. Again, this helps you to, again, maintain your account, not blow it all. I see some people wanting to flip an account from like 1,000 to like 5,000 or 10K, and in a short period of time for that matter. And for you to do that, that means you would need to risk a very high percentage of your account, and there's always that risk of blowing your capital. So the advice is always to try and risk between 1 to 2%. For me, I never go above 2%. Sometimes I mainly trade 0.5 to 1% of my per trade actually. And so I'm really conservative when it comes to my trading account. And in that way, even if I have a series of losses, my account is still very much safe, and there's no way that I'm going to blow my account because I don't risk too much. Um, you also need to set your stop loss as well. So no matter how confident you are in a trade, anything can happen. It could just be a news out of the blue that would plummet the market. So always set a stop loss, and you need to make sure that you calculate your positions very well to know how much your 1 or 2% is in terms of your the stop loss that you're setting, and make sure you don't go beyond that level. And also determine your risk to reward ratio. So as a rule for myself personally, I try to at least have a risk to reward ratio of 1 to 2. But I would say the best is to have between 1 to 3 or 1 to 4, because that would give you, even if you don't have a strategy that gives you 80% win rate, even if it is 50% win rate, with a very good risk to reward ratio of 1 to 2, 1 to 3, at the end of the day, you will still be profitable in the market. So make sure that you have a good risk to reward ratio. And I recommend to have at least 1 to 2 risk to reward ratio. The third step is to try and define your entry and exit strategy. So at what point do you want to enter the market? At what point do you want to exit the market? And again, this will depend on your strategy, what you uh, determine as your entry signal in terms of do you use indicators, do you use chart patterns, candlestick patterns, do you use support and resistance, trend lines, Fibonacci retracements, whatever strategy you use, you need to be able to write it down on paper or type it up on your computer to say, this is my entry signal, this is what, if I see this and this and that, then I will enter the market. And if this and this and that do not align, then I will not enter the market. So you need to set that strictly for yourself. And then you also need to set exit rules as well, when to leave the market. Are you going to be trailing your stop loss as the market goes in your direction? Would you be moving your stop loss to break even and then even ahead, such that if the market reverses, you will still have something at least taken out of the market? Or would you just set your profit target at a specific area, maybe at a support level, or a demand resistance level, or when the price hits like a moving average or a trend line? But just make sure you set a rule for yourself as to when you want to leave the market, and not hold your trade longer than you're supposed to, or take a profit when you're not yet supposed to. The third step is to record and review your trades. So journaling, extremely important. This way it gives you a way of going back, having a look at your mindset when you took the trade. What were you thinking of? What did you say to make you want to take the trade at that particular point in time? This would help in future trades when you're in a situation or similar situations. You'll be able to look back at what sort of decision you made. Did that lead to a profitable trade? Did that lead to a failed trade? Were you rushed into the market? Was there any sort of thing really that prompted you to want to take the trade? Did you follow your strategy to the letter, or did you deviate from it? All this need to be journaled, and then this would help to track any sort of mistakes and also help you to make improvements as well. And then using your journals, you can also tweak your strategies to help again improve your trading, because sometimes the market direction changes, or the market generally changes, and so you might need to adjust your strategy to fit the change that has happened in the market. So that's why journaling is very important, and I'd suggest that you start to do that as well. So generally, these are the steps that you need to take to create a very good trading plan. Your trading plan should answer the following: what are your goals? So you should be able to know what your goals are at the end of the day, what you aim to achieve. You're supposed to know how you will trade the market, so your entry, your exit strategy, what sort of risk you are willing to take as well, and how will you then track your progress. So your trading plan is supposed to address these four major questions. And if you already have a trading plan and they are not addressing these questions, then I suggest you go back, go through your trading plan and try to make it much more comprehensive so that you can follow it to the letter and prevent any sort of emotions from taking over. Sometimes we follow our strategy to the letter. Everything is a check box. We are able to check all the boxes, but then again, the market moves in the opposite direction. That is absolutely fine. It is very common for that to happen. Even if that happens, just move on. Again, analyze another market, another pair or same pair later on, and still follow your trading plan. And eventually, being consistent, you will end up profitable. So I hope this video has been very helpful for you. If it has, kindly leave a like, and if you haven't subscribed, kindly subscribe to the channel for more analysis. So to close this, remember, plan the trade and trade the plan. Thank you very much for watching and have a fantastic day. Cheers.